This is Raghee Horner, and welcome to the day trading webinar. I'm really excited to be able to present this because it's probably one of the strategies I get the most questions about, but it's also, in my opinion, of course, one of my more straightforward, very visually oriented strategies where I really don't depend upon a lot of time-consuming calculation. I really depend more on what I see on the chart. So really this is all about wave angles and grab candles and a few key moving averages. I should say 4 key moving averages. This is not a long presentation in terms of all the details and nuances. It's really more about making sure you get the setup on your 5-minute chart right. So let's talk about what this is and what this isn't, and let's kind of go over to the whiteboard, if you will, my makeshift whiteboard, and let's talk about some of the factors, some of the tools, some of the decisions that you're going to have to make, and in terms of what it is that you should expect from this particular strategy. All right. So first of all, in terms of what we're looking at, remember, what is day trading? I just want you to think about this for a moment. What is day trading? And you can see my scribble. It's not easy writing on these things, but what is day trading? What is a day to a Forex trader? Well, we know for us it's a 24-hour period, right? We have 24 hours. So what is a day? Well, if we were talking to stock traders, they can define their day very easily. We're talking about 9:30 to what? 4 p.m. Eastern Standard Time, of course, right? So 9:30 to 4 p.m. is their day. But when we're talking about a Forex trader, we really start asking ourselves, whose day, right? Because is it a trader in the U.S.? Is it a trader in the UK, Europe? You know, what's the story there? Whose day is it? So then it breaks it down to another level of analysis, which then begins the talk of which session are we going to trade, right? Which session? Now, in terms of session, if you guys have been following me for any length of time, you know that for me, the U.S. is my preferred session. I like trading the U.S. market. I like the fact that I can take advantage of the U.S. dollar. I can take advantage of, Wall Street opening, right? I like that. I like the fact that I get those U.S. economic indicators, in terms of eco data. Okay, now we're talking about those factors that are going to in turn affect Wall Street and the U.S. dollar. And of course, that's going to affect any pair that trades against the dollar. All right, so what's always the one commonality I talk about? Let's talk about the 3 majors. We've got the euro US dollar, we've got the dollar yen, we've got the cable, the British pound US dollar. So when we talk about these pairs, and we take a look at what's been analyzed and reported from the Bank of International Settlements, I think that's BIS.org. You talk about the Bank of International Settlements, and what they've said is where is the attention, where is the daily turnover. And in terms of session, yes, that might be the UK and Europe overlap. But in terms of the most commonly traded pairs, it's really, these 3 are still the majors. What they call the majors. You guys should know that. That's kind of Forex 101. Okay, but then we have really the pairs that trade against the dollar, not just those pairs, but, we talk about the extension of those US dollar pairs. Now we're talking about US dollar, Canadian dollar. We talk about the Aussie, right? Can't neglect the Kiwi. And I'll throw in another pair, and it's not a dollar correlated pair, but it's one that I think has a tremendous application to risk appetite, risk aversion. That's the cross rate of the euro yen. So kind of a separate pair there. But this is an extension of the dollar correlated majors, and I call these, in terms of, I think everybody calls these COMDOLs, but I also call these dollar correlated. So when I have this dollar correlation, I know that I'm again going back to that reliance on US data. What's Wall Street doing? What's the dollar index doing to affect my decision making as to the attention being placed on the market? All right, so what does this have to do with day trading? We're talking about whose session are we trading and which pairs. Well, for me, there's 2 times that I'll consider day trading. Actually, 3 times. Let's talk about the times we can consider day trading in the world scope of things. Okay, so it is a worldwide market. We don't want to neglect that. So there's 3 distinct times that we can consider day trading. For me, I love having the equities attitude, the stock trading attitude that I had way back when, back in the mid to late 90s, where we really focused in on the open of the market. Well, the open of the market when it comes to Forex is the open of an individual financial center, right? An individual financial center. So now that brings us to thinking about what are the financial centers. Now, I will say before we get to the individual cities, my experience from traveling the world, my experience, I'm sure just like yours, if you've traveled to any other country, everybody pretty much seems to work about an 8 a.m. to about a 5 to 6 p.m. day. I don't care where you are in the world. Okay? That seems to be what people work. And if that is the fact, I can take a look at the financial centers, starting with Sydney, and the first look at a trading day, moving on to Tokyo. Okay, so look at the Japanese market opening. I can then head on over to Hong Kong and Singapore. Let's try this again, right? Singapore. I am completely screwing up here on my financial center spelling here, aren't I? Let's try this again. Okay, so we'll do this cleaner. Sydney. And I thought handwriting would be quicker than typing everything out. So Sydney, first look at the new day. I mentioned Tokyo. Then Hong Kong. Singapore. That comprises the Asian session. Then we move on to Paris, Frankfurt, and of course London, the 800-pound gorilla. And then we move on to New York. And those are our 3 distinct sessions. Now there's an overlap between all these. We'll get to that in a moment. But what I want to do is consider that each one of the opens is potentially a time in which I can take advantage of a day trading opportunity. Now, I am here in Florida, so I think on Eastern Standard Time. That is the way my clock is set. That is the way my mind works. So let's break this down. To me, kind of Asia really gets going, not with Sydney, but really with Tokyo. So if I'm going to focus in on Tokyo, that's going to be the first opportunity that I have to day trade. And I'm really taking advantage of the Japanese market open, the Nikkei opening, etc. That push of opinion and of volatility. So look at what 8 a.m. in Tokyo translates to where you are in the world. My second opportunity, this one's kind of interesting because you do have a push of volatility, you do have a push of participation with Paris and Frankfurt, but really It's much larger with London. And again, when is it 8 a.m. in London? You know, for me, that turns into 3 a.m. again, Eastern Standard Time. I don't usually get up at 3 a.m. That is a really ridiculous hour of the morning for me to get up and expect to be functional in any way. So, that means my day trading efforts are usually focused on the U.S. Open. And what you want to do, I know I listed 8 a.m. here, but for me, you want to look at, like, for Tokyo, when is the Nikkei open? The FTSE here. Okay, you can look at the DAX. You can look at the CAC 40. You know, when do these equities markets open? For us, it's all about the New York Stock Exchange, the NAS, right? The SPOOs. So you want this overlap to respect when the equities markets open. So for the U.S., what time am I focusing in on? 9:30 a.m. Make sense to everybody? On my chicken scratch here on the whiteboard. So my day trading is really going to overlap the 9:30 a.m. But at the same time, I'm still going to keep that 8 a.m. focus, because we're going to look at power stats here shortly. I'm going to keep 8 a.m. because that's the first increase in the pip movement range. So you guys know I talk about pip movement ranges a lot. The first push in the pip movement range happens with the 8 a.m. because we're going to have 8:30 economic releases. Especially on mornings where we have 8:30 economic releases, we're going to see that volatility push higher. Yes? Everyone understand that so far? So that's the first concept. It's the when. What are you trying to capitalize on? You can day trade throughout the day. Don't get me wrong. You know, day trading can be done throughout the day. There's no question about that. Let's bring the charts in here for a moment. Let's look at the charts. You'll notice hopefully right away that this is a 5-minute time frame. All between the greens, the day trading strategy that I use for my Forex, and by the way, not to confuse things, but I'll trade stocks day trading this way. If I'm going short term, I'll trade my futures day trading this way, again short term. So this is how I treat price action on a very short term time frame. This slice of psychology for me is manageable on 5. Let's talk about what it means to trade a 5-minute chart and what it means to go short term and the positive and negatives of a short term time frame. First of all, what does it mean? Well, look at the number of candles you're going to get per hour. You're going to get 12 new candles per hour. What else are you going to get? Well, you're going to get a whole lot more shifts in the market trend, in the market phase. You're going to get more and quicker transition from one phase to another on a 5-minute time frame, because we're talking about a 5-minute look at psychology. So it's quicker. You're also going to find that you don't have the luxury of time. In other words, when you are looking at this 5-minute time frame with the quick succession of candles, and you know, granted, some traders who are used to 1-minute charts, who are used to tick charts, might find a 5-minute chart relatively slow. But I find a lot of traders, if they're managing multiple pairs, so let's say you're looking at the dollar yen, euro US dollar, the cable, the Canada, the Aussie, the Kiwi, the euro yen, the dollar, you know, you're looking across 6 to 7 pairs on a 5-minute time frame. My hypothesis is you don't have the luxury of time to be drawing complicated and, you know, taking the time to draw and analyze complicated tools. So what is complicated? Well, you know, one of the things that I'll try to not tell traders that they have to rely upon as much are things like, for example, doing a lot of manual trend line drawing. That might be very, very simple for a lot of people, but what happens is, and this is what I want you to think about for a moment, it's easy to let a chart steal your attention, because before you know it, you're just starting to draw trend lines, and all of a sudden you notice something, and then you notice something else, and before you know it, 30, 40, 50 seconds have gone by, maybe a minute, and that might not sound like much right now. Okay, you might look at past highs and near-term highs and lows, and all of a sudden, you've just spent an inordinate amount of time making analysis on one pair while you have 5 or maybe 6 others that want your attention. So suddenly you realize you might have put yourself in a position where you're having to miss trades. I don't want you chasing trades, and so therefore, the quicker you can keep rotating your eyes to the different pairs and what the price action is building in terms of a picture, in terms of a story, the more you'll be able to capture the moves as they are happening. So again, going back to time as a con, as a down, as the downfall to day trading, short-term time frames, you really have to rely, I think, on visual tools, and you really have to rely on keeping in mind that you don't want to focus all your attention on one pair, because in my opinion, if you focus your attention on one pair, one symbol, you'll force trades, you'll squeeze trades, because human nature oftentimes dictates that if this is all I'm looking at, the 5-minute dollar-yen, that if nothing's happening, I will make something up in my mind, because the brain likes to stay active, and if there's nothing to do, it will make something up. Think about staring up at the clouds in the sky. You stare at it long enough, you will see something, whether it's there or not. So keeping in mind this idea of bunnies in the clouds type idea, you stare at anything long enough, all of a sudden things are going to start coming into shape. Oh, I see this here, I see that there. The mind likes to stay active. And if the mind doesn't have something to focus on, it will find something to focus on. That's the problem. So you start looking at clouds, you start forcing trades. That's what I call looking at clouds. You start, looking at what your brain is now given the luxury of trying to make up. All of a sudden, I find you're going to start forcing or seeing trades that aren't there, or forcing trades. What does forcing trades mean? Well, we have one downfall, if you look at one time frame, which is you're going to see things maybe that aren't there if that's all you're looking at. And 2, if there's nothing to do, you will want to do something, and you will start to trade, I think, overly aggressive. That's been my experience from my own trading. That's been my experience from observing literally hundreds and hundreds of other traders. So when you go short term, and this probably has as much to do with trading in general as it does day trading, but I find day traders can sometimes fall victim to this more often, because it's a little bit more hyperactive trading, isn't it? It's a little bit more short term, a little busier type trading. I don't want to imply that day trading is busier trading. I just find, think about it again, because we are presented with so many more candles, so many more potential shifts in the market trend, so many more potential resistance and support levels and touch points that we can draw trend lines from, there will be technically, because of that presentation of a day's price action with more candles, there will be potentially more to do. So think about that for a moment. It's not that you're seeing any different a price than someone looking at, say, a daily time frame. They're seeing the same price. All right? But what you are looking at is a different presentation of price, a different slice of psychology. It's broken down into smaller chunks, so all of a sudden there is more analysis that can be done per candle. Not a whole lot to be done when you're only getting one candle per day versus 12 candles per hour. 12 candles per hour, 24-hour day. Do the math, right? So there will be, because of that, more ways to slice and dice price action. One of the things I mentioned before was looking at the power stats, looking at the way the rhythm of the trading day behaves. So let me show you that really quick. So here we have the AutoChartist platform, and within this platform is the analysis for price movement. You'll see that right here. Let's blow this up a little bit. And what I want to show you is the movement per hour of day. This is Eastern Standard Time. And what you're looking at here is a breakdown of the 24-hour Forex trading day. Think back to the first part of our talk here, the first segment, if you will, where I talked about on the whiteboard and the different zones, the different times, the different financial centers you could consider day trading, and then the different bursts of volatility with the opening of Sydney and Tokyo and Hong Kong and Singapore, Paris and Frankfurt, and then finally New York. 2 a.m. Here's 2 a.m. Eastern Standard Time. You can see the pickup, the sudden pickup, not only in the average pip per hour, but the overall volatility picks up again. The average pip per hour picks up again with 3 a.m. That is London joining the party. It also picks up in volatility. This is the high to low range in terms of average pip movement. The band across it is the average. So the average high to low in terms of how many pips we could move, so almost 60 pips per hour to the high side, about 25 pips per hour to the low side, but on average about 40 to 45 pips. Again, that's for the hour from 3 to 4 a.m. Eastern Standard Time, the hour in which London really starts gearing up for their trading day. You can see that here. 2 a.m. That's 8 a.m. in Paris and Frankfurt. 3 a.m. Again, Eastern Standard Time is 8 a.m. in London. We get a little bit of strange volatility here. Why is that? Between 4 and 5 a.m., Asia's leaving the party. Sydney, Tokyo, Hong Kong, Singapore. The Asian session is generally understood to be kind of winding down with the 4 a.m. Eastern Standard Time and hour. And remember, Forex isn't like a bell ringing. This isn't Wall Street. This isn't suddenly the market just comes to a roar and wakes up. Consider what Wall Street is, and I'll throw in the futures markets as well. Consider what they are in terms of their behavior. The market closes. With the market closing, you have a period of time where people can formulate opinions and economic events occur and geopolitical events occur, and suddenly all those opinions, that pent up action that's ready to hit the markets, is released with the ringing of the bell at 9:30 and Wall Street opens. That's not the way the market behaves in Forex, because it really doesn't close, which is why we had that first segment where I talked about the individual financial centers and when they open and close, because you really have this rollover, this overlap throughout the 24-hour Forex trading day with smaller events like the bell ringing. So we're kind of having this smaller event. I say smaller in the picture of the overall daily turnover, but they are certainly events that have a lot of impact. Okay, they have impact as in kind of individual bells. Okay, so think of the individual bell occurring with Paris and London, and then again with New York, and then again with Sydney and Tokyo and Hong Kong and Singapore. Okay. I also want you to notice another thing in terms of the rhythm of the trading days. When is there the most volatility? 8, 9, 10 a.m. Eastern Standard Time, that overlap that New York has with London, Frankfurt, and Paris. Look at the quieter part of the trading day, the 24-hour trading day. Look how quiet it is when you look at Asia, until you see the pickup with the Paris, Frankfurt, and London Open, levels off, right? And then we have a pickup again with the US. So you've got Europe, you've got the UK here, you've got the US here. This is Asia. So look at the difference. Okay, look at the difference in terms of the averages. I want you to notice that. Very important to notice, because this will help you gauge your expectation of follow-through, of pip movement, of volatility. That's what this does help you identify. So this is a very important part of understanding when it is volatility could pick up, because what a lot of people look at volatility as potentially what they could make, right? To me, that's a mistake. Volatility for me, let's talk about that for a moment. Volatility for me, in terms of the price movement, these financial center overlaps, what is volatility? I think a lot of people look at volatility and they think that's wrong. Okay, in my opinion, volatility is risk. Yes, it's reward, because if the market doesn't go anywhere, we're not going to make any money, obviously. But I think the safer way, the more prudent way to view volatility is to view it as risk. All right? And so when the volatility increases, so does your risk. When the volatility decreases, I believe your risk is less as well, but then, we don't want to also negate the fact that no volatility is no good either. It makes us angry, right? Don't you love my high-level drawings here? I am the Picasso of the whiteboard, am I not? Okay, so we have to look at it. I'm not going to say volatility is always, terrible, it's risk, but I think it always helps us to be more prudent about our trading, and therefore, obviously, I'm going to acknowledge that no volatility makes us angry. In fact, that's one of the reasons I don't necessarily like trading Asia. It's not a lot of price movement. In fact, to go off on a little tangent, think about it for a moment. 8 a.m. Eastern and 8 p.m. Eastern. So again, now we're talking a.m. over here and p.m. over here. This is over here at 8 a.m. We're talking about what? We're talking about Europe. We're talking about UK. That's a K. We're talking about US. Here, we're talking about solely Asia. The difference in pip movement is dramatic, is it not? Take a look. The difference in pip movement is dramatic. And this isn't just the Euro-US dollar. I don't want you guys thinking, oh, Raghee's just looking at the Euro-US dollar. I'll look at the cable, because for those of you that do like to get up early, let me show you the cable. Movement per hour. Very different, right? Pretty interesting. Again, this is Eastern Standard Time. 0 is midnight, 2300 is 11 p.m. New York time. So look at the pickup. Asia is still very quiet. You see that? We still have a lot of very quiet price action through Asia. No doubt. Very quiet. We do get that pickup I talked about with the US, right? But look at the pickup with Europe and the UK. For the cable, it's huge. In fact, it's the more volatile time of the day. You see that? It's absolutely the more volatile time of the day. So we've spent a lot of time setting the scene here. Okay, I'll show you one more of these price movement per hours, and then we'll go on to the charts. The chart setup and the management is really, I hate the word to use, easy. It's simple. I like the word simple compared to easy. Okay, it's simple. Simple doesn't necessarily mean that it's effortless. It just means it's not complicated. Okay, don't think that easy and simple are synonymous. I think we strive to make things simple. Simple is what we seek. I'm a simple trader, and I don't look at that as a put down. I look at that as really the hard work I put in of going on 20 years. I want things to be simple, but it's never easy. In fact, keeping things simple is tremendously difficult. I want you to see the rhythm of the dollar yen before we move on here. So there's the rhythm of the dollar yen. Let's get to the charts here. I've spent so much time talking about when and how and the psychology and the rhythm, because it is not difficult to set up the charts for the between the greens. I'm also going to stress psychological levels. I'm also going to stress looking at certain moving averages and near-term highs and lows. So all the levels that you will have to consider are pretty much in front of you when you are doing this 5-minute day trading strategy. There's not a lot by way of having to do a lot of heavy lifting when it comes to analytical work on the chart. Again, I talked about it in the first segment. We don't have the luxury of time. And if you're managing multiple 5-minute between the greens entries across multiple pairs, you don't want to be bogged down on one chart. I don't want you getting in and doing a lot of manual work, because it has a way of sucking you in, right? It has a way of taking a whole bunch of time, and before you know it, you spent a few minutes on one chart, and that might not sound like a lot, but in the 5-minute world, it could be. So, rhythm of the trading day and volatility and who's awake, those are big decisions. And also, when should you use a 5-minute strategy? When should you even start looking at this? Well, we've talked about the fact that during certain types of overlap, certain times of overlap, for example, the Asia versus the US session, the pip movement range does present, in terms of just pure pip movement range, how much the market could move, it does present less risk. In my opinion, a 5-minute time frame can present less risk as well. Look, being in the market, just being in the market is risky. As traders, we are risk managers. So don't misinterpret what I'm saying as 5-minute time frames in Asia are risk-free. Don't even think that. What I am trying to get across is it's a different view of the risk, because we're taking smaller adventures into the market. The longer you're in a market, the more risk I think you are willing to accept, because being in the market is risk. So having said that, I don't want you thinking 5-minute is suddenly risk-free or less risky. You're in the market, but anytime you're in the market for less amount of time, I feel overall, generally speaking, there's less risk involved. One of the main reasons, though, that I day trade the 5-minute chart, or day trade period, is because there are times when we lack sentiment and momentum and lack longer-term trends, and therefore the directional bias of certain pairs, like what we're seeing on the dollar-yen right now, it's a daily chart, just simply isn't there. The clarity of the market just simply isn't there. When we don't have that clarity, it's much more difficult to gauge follow-through and expect an organization of bullishness to carry us higher or an organization of bearishness to carry us lower. Very important, okay? So, we're going to talk about the trade setup. We're going to talk about what I look at. It is simple. It's not easy, but it is simple. And always seek to add that element of keeping things simple, making them simpler, okay? Making them simpler. If there's anything I want you to get out of our time here today, other than the day trading, is our goal. Your goal as a trader, I think our goal as human beings, period, is to make things, in this case our trading, simpler. That is our mantra. Simpler. Okay? Make things simpler. All right. So having said that, here is how I tweak my 5-minute chart for the between the greens. And the cool thing is this will be available online, so even if you don't quite catch everything live, like you want to go look at those power stats later on, this will eventually be posted up at YouTube, so you can freeze frame and watch it later on. That's the great thing about this. So keep in mind that if you don't catch it now, catch it on the replay. No worries. Let's go into the setup here. What you see here, and by the way, gang, I'm not going to have a lot of, I don't want to get into what grab is and what the wave is, because I'm assuming if you're getting to this point of day trading, you've been watching me for some time, and you also know what some of these tools are. And if you don't, no worries. What I would then recommend you do is head on over to YouTube, youtube.com, And you can either go ahead and type in youtube.com/InterbankFX videos, or you can just look at InterbankFX videos, and it should bring you to the page. There we go, InterbankFX videos. Just click on that link there. And here is the
This is a quick video
InterbankFX
to demonstrate one-click trading
website
on the MT4 platform with IBFX Australia.
All right, so here is and you can see one of the videos sort of playing right away. Here is the InterbankFX videos channel. And what you'll notice is there's, how many videos? We have a lot of videos here. I don't know how many we have, but we have a lot. So when you look at the channel, I have a number of playbacks that are here. I think we did a Back to Basics series, and it should be up already. So you can look at Back to Basics. I think there's some Back to Basics videos here. Let me make sure. Is that it? No, that's not. Well, although that is very good information too. I'm trying to. What you could do is, or just search me. I've got past videos here that are available for viewing that explain what the wave and what grab candles are and all that kind of stuff. So I just want to give you that resource. And the other resource is heading on over to the Daily Forex Trading Edge, dailyforextradingedge.com, and under Education, this might be the easier way to go. You can see our webinars listed here. And this is today's webinar, obviously, but all the new webinars will also be listed here as well. And you can check out the videos here as well. So a lot of really good information, and trying to understand what the wave is and the 34 EMA wave and grab candles are, it'll be explained here. Alright, so back to the charts. So the indicators that you are going to be using for your day trading, your 5-minute between the green setup. You see I've got a couple here, but I'm going to show you how I clean this up. You can have your grab running. That's no problem. What I would probably tell you to do, and this is something that I don't necessarily recommend for everybody. For most people, I will tell you, go ahead and simply turn your grab off and just put the moving averages, the Fibonacci-based moving averages, on one chart that's dedicated to 5-minute between the greens. For others of you, what you could do, and this is something that'll take a few minutes, but then you can save the template, and this is what I was going to do here, is you go into your study, and what you essentially do is, I'm going to just show you here real quick. See how I changed? I went to the very last setting under the IBFX Grab R and made it white. You see how it made the 34 EMA low essentially disappear? The grab candle is still there, but the 34 EMA low line disappeared. Then I'll go into green. I'll edit it. Again, I'm going to the Colors tab. The very last one, I'm going to go ahead and turn white, and you'll see what happens. And watch where the green line goes. Boop, gone. And finally go to the blue. Go to Colors. That last one, number 4, can go white, and it disappears. Now I still have the grab candles up, so I can still see sentiment and momentum. But I've ditched the wave. And I'll show you why this is important, because we're going to put 4 other moving averages on this chart. So you consider, if I have grab running and I have these other between the greens moving averages, all of a sudden your chart's going to get awful difficult to read. So it's nice to have the grab input, but you don't necessarily need the wave on top of here. You will use the wave, and I'll explain shortly. So that's one tweak. And this is a tweak for those of you that want to do this. It's really up to you. The moving averages you are going to need are the 13 period, exponential on the close, and I actually like to paint this one lime green. The other moving average you're going to have is a 21 period exponential on the close, and I paint this one green. Now, if you notice, I'm just editing the moving averages that I've already got on this chart. If you were to start fresh, like I'm sure some of you will, you'll go up into Insert Indicator, look at the overall heading on your platform, go to Insert Indicator. Moving averages are under the trending headline, so you can go there and bring up the window that way. We're going to bring up the 34 period exponential on the close. That one is going to be red. And then finally, we're going to have a 55 period exponential on the close, and that one's going to be this maroon color. So essentially what I've done, and take a look, we'll go back in, 13 period exponential close in lime green, 21 period exponential close in green, 34 exponential in red, and 55 in maroon. All exponential, all on the close. And you notice it's put 4 moving averages on my chart. Now, imagine if you would, if I had the wave here as well. Be awful messy, right? So this keeps it very clear. Now, I do want you to think about one thing, and that is we only utilize the, and I want to show what it looked like. See how messy that is? It's very difficult to read, right? It's a 5-minute chart with between the green setup and the wave. Very difficult to read. So again, what I recommend you do is edit each one and make it white. Go to each of one of these, the B, the G, and the R. Make the last heading under the Colors tab white. You're going to see how clear this makes the chart. Now, at some point, you're going to have to look at a 5-minute chart with the wave on it, because here's the big part here, gang. Remember, I'm only going to use this strategy when the 5-minute time frame is either in a 12 to 2 or 4 to 6 o'clock market trend. In other words, you've got to have an up or down trend on the 5-minute chart to do this. Notice another tool that I have on here, my order entry. This is an EA that runs on the chart. It's a little mini terminal. That's what it's known as. And if you go into your navigator on your platform, you'll see there is that mini terminal you can put on there. And that terminal will allow you to execute trades right from your chart. And when you are looking at trades that might happen in quick succession, to me, rather than bringing up the old-fashioned ticket, the more traditional MT4 ticket, I'd rather have the Interbank FX little terminal sitting right on my chart. It makes it very simple to execute what is sometimes a trade that comes along with very short notice. However, I want you to think about something which many of you might have already thought about. This is really akin to swing trading on a short-term time frame, right? And if you haven't thought of it already, this is very similar to swing trading on a short-term time frame. But instead of waiting for corrections to the 20-period simple or the 34 EMA high or low, I'm going to be using a zone that is created by the 13 and 21 period exponential moving averages. By the way, these are very much related to the wave because all the levels that I have put on this chart are Fibonacci numbers. I don't stray from my Fibonacci numbers based moving averages. I don't stray from those. The only exceptions really are the 20, the 50, and the 200 period simple because they are so psychologically relevant to the market at large. So this is the setup. I have the terminal set up here. I've got rid of the wave because at some point I do have to look at a chart with the wave on it. A really easy way to make sure you can toggle with simplicity between the two. Okay? You're going to save this template. Call it whatever you want, between the greens. Then you can also have a template that is simply the wave. Now my default template is that look with the wave. So if I want to make sure I'm dealing with a pair that is in an upward down trend, I will do so with the wave. You must. Okay, you have to have that 4 to 6 or 12 to 2 o'clock angle. Up or down trend. You must, okay? Can't stress that enough. But then when I'm ready to trade, when I see if there is an angle like there has been much of the day, you can see today has been a great day for between the greens trading. Boom. I'll go to my template. Oh, what happened there? I must have not saved it properly. But then I'll go to my template. Now I'm realizing as I'm doing this here, as this luxury of doing these things live, that it may not actually be cooperating. I actually have a second set of studies that are grab only, and maybe that's something we need to have available. And I'm actually going to make a note right now to myself that we might need a grab candles only study. So I'm making a note of that right now, and I don't think that's going to be tremendously difficult because we already have the grab study, so we'll find out what we can do to have a grab only. But if you don't close your window or jump around with templates, if you have just one window dedicated to this or one profile, that might work as well. If you create a profile, that could work. Creating the profile, interesting. But if you have a day trading profile, I'll look into that, and we'll have maybe some follow-up on this at some point. But having this view, grab plus the between the greens, becomes very helpful. Now, let's talk about the setup. Okay, let's talk about this between the greens setup, because it's not difficult, hopefully now, for you to see how visual this is going to be. This is the awesome part, if I do say so myself. All right, looking at this chart, I'm going to go through a bunch of 5-minute charts and show you, first of all, what the chart with the wave look like, to number one, confirm that we can even consider this strategy, and then number two, where the entries are, and then where you can look for potential exits using all visual tools, So let's start with the confirmation part, because that is the most important. So what I want to do here is jump over to the view of really just the wave. Okay, so I can get rid of some of this other stuff. If you want to keep the other moving averages, that's fine. You really don't need them. What I've really left here is a 200 period simple. Okay, the wave, the grab, and then of course my terminal. So let's go to a 5-minute time frame of the Aussie, and here is the 5-minute time frame. We want about a 1.5 to 2 day market memory or look back, so we can get a proper angle of the wave. And let's go back in time a little bit here, since we have that luxury. This is the time where the wave is moving down at 4 to 6. This is where the between the greens short sells would be valid. Look at the 12 to 2 back here. Look at the 4. I mean, take a look at just the day and a half, how many times we've had trends. That's what we're focusing in on. I don't want this nonsense. This is not what I want to focus in on. This stuff, when I'm looking at what I could do, this is not what I want to be focusing in on. This is. Okay, this is 4 to 6. Okay, that even back in here. Okay, slight 12 to 2. 4 to 6 and 12 to 2. That's what I want to focus in on. Not the sideways 4 to 6. I'm sorry, not the sideways 2 to 4 or 3 o'clock wave angles. That is not what I want to focus in on. Only trends. I cannot stress that enough. If the 5-minute chart with the 34 EMA wave is not giving you a clear view of consistent green grab candles and a 12 to 2 o'clock wave, and if you're not getting a consistent view of 4 to 6 o'clock grab candles and a 4 to 6 o'clock wave, okay, red grab candles, 4 to 6 o'clock wave, or green grab candles and a 12 to 2 o'clock wave, if you're not getting that, do not take the next step. But if you are, then go ahead and take the next step, which is jumping on over to the between the green setup. 13 period EMA on the close, 21 period EMA on the close, 34 period EMA on the close, and finally the 55 period EMA on the close. So to look at that same chunk of time, we were actually focusing in on this time back here. What is the entry? Super simple, completely visual. I probably could have told you this in 5 minutes and said, okay, webinar over, but there's so much more to it, right? You want to go short term when there's not an organized sentiment and momentum on longer term time frames. You want to go shorter term when you're not expecting the longer term follow through. If not, I just assume you focus on longer term trends and benefit from those. You want to focus on shorter term if your risk appetite isn't there, or you're a little bit more risk averse and you don't want to spend a lot of time in a position in the market. You want to get in and get out with a little bit more frequency, but also holding your trade for less time. This area right here, talking about a short sell, short sell, short sell. This fell just shy of it right there. Short sell. Let me show you why and how. So first of all, trend is down, right? How do we confirm that? We confirm that by looking at the chart with the wave on it. Within the market memory, confirming the 4 to 6 o'clock angle. If it makes it easier, I'll kind of scrunch the data so it looks the same. This is the view of the between the greens. While the market is in a 4 to 6 o'clock angle, showing that the 5-minute chart is in a trend, there are a number of times that prices correct up into the area. Now I'm going to zoom in a little bit. Correct up into the area between the 13 and the 21 period exponential moving averages. You see this? It's like a zone. For those of you that are familiar with the zone between the 20 period simple and the 34 EMA high or low when I'm swing trading on longer term time frames, this should feel very comfortable. It's swing trading on a shorter term time frame. You're trend following a shorter term slice of psychology. So here, okay? So what I'm trying to show you here is now we have these periods of time where the price action corrects higher within the context of the downtrend up into the area between the 13 and the 21. Look at all these. I mean, it's not just one time. Over and over and over again. Eventually you're going to have a losing trade. That's what this one and probably this one was. And then boom, that's where your loss occurred. But all these entries, really your losing trade was in terms of when the market finally shifted. When did that finally happen? Really only this one and this one, right? So the bottom line, and this is how simple it really is, once you have made sure you are stepping into the strategy at the right time, if there's anything that I hope I get across in all my trading is that trading is all about making sure you're using the right strategy at the right time. Here, this is a trend following short-term trading strategy that capitalizes on a trend and a correction. This is swing trading with a zone created between the 13 and the 21 period EMA. That's it. Okay, if you're already familiar with my swing trading, you're instead of a 20 period simple and a 34 period, you're going 13 and 21. I choose a shallower correction because my experience has been shorter term time frames typically don't correct with the same type of magnitude that longer term time frames do. That's the reason. But I still keep the 34 in there. That's what this red one is. It's the 34 period EMA on the close. So I haven't completely taken the wave out of the picture. That's the middle line of the wave. The 34 period EMA on the close is this red line right here. But the reason I call it between the greens is because your entry is triggered between the greens. Yes? that's where your entry is triggered. Trend following, correction. Notice I don't have to pull up a Fibonacci. I'm not doing any kind of more time-consuming analysis. Once I've confirmed the trend, it's just a matter of waiting for prices to get into this area. What else does the fact that I've got visual tools with a footprint, in this case the moving average footprint, what else does it do for me? If I have the time, I can actually go ahead and trigger a conditional order. I can actually go ahead and put in an order to sell on the 13 period EMA low, or on the 13 period EMA on the close, or on the 21 period EMA on the close. I can put my order on that, or in between. I can go ahead and be a little bit more proactive. I'll have to update it more often. I do want you to remember that. If you do get proactive, remember every 5 minutes this value is going to change slightly and you're going to have to adjust. But if you feel that you want to do that, you can. There's a footprint here that you can watch and follow. What about buys? Let's take a look at another chart. Looking at an uptrend, let's jump on over to the dollar Swissy. What do you see here? 12 to 2, right? Now, realize the minute you can confirm this as a 12 to 2, you can start considering waiting for the pullbacks and looking for the between the greens. Same thing at the minute you can actually confirm the markdown trend, that the fact that we're looking at a 4 to 6. This is very akin to swing trading. In fact, the more comfortable you are at swing trading, the more comfortable you will be at this between the greens setup. So here's our confirmation of, yes, it's the right environment. We can go back to when we started really seeing a 12 to 2. Here's our between the greens. Let's look at it on the same scale. All right. So zooming in, where were the opportunities? Well, we didn't quite, gosh, it was so close right there. Let me zoom in a little bit more. You can see what I'm talking about. We didn't quite get there. Here's that one pullback. It was pretty good. Didn't quite get there. Easily got there at the correction that actually pierced the 13 period EMA on the close. Actually got into the zone. Okay, we missed it here though. Here's another one. Another one. Easy, easy. Absolutely would have gotten the entry. Would have taken some heat even. Again, miss, miss, miss. Here's another one. And then finally, what happened to those last two? That's where we actually started seeing the shift. Now, if you notice, and this is something you can also do. So this is where things went badly eventually, and then we can see what happened. What I want you to keep in mind is that if you notice on your chart with the wave on it, the wave starts to flatten out, starts giving you more 2 to 4 or 3 o'clock, stop doing this. The environment's all wrong. This one we really didn't get that much of a warning, did we? This was actually a quick transition or a short cycle. We just went from green to blue on the wave and boom to red. You see that? Now, one of the other things you might notice is that unlike 34 EMA wave, longer term swing trading, unlike that, where oftentimes our correction is going to come with a blue neutral grab candle. Here's one of the reasons I like having the grab candles on my 5-minute chart when I am day trading. Notice that in both these setups, the buys and the sells we were looking at on the Aussie, and the buys we're looking at here on the dollar Swissy, we didn't go blue on any of these, did we? In fact, when we go blue, we start looking at potentially where the market's going to shift. So one of the filters, for those of you that would like a filter, is make sure your grab candles are green. I mentioned that early on, 5-minute chart, green grab candles, 12 to 2. Downtrending chart, red grab candles. That's your ideal situation. When things go blue, you probably don't want to do this because why? Blue grab candles, what do they reflect? A neutral market trend. Let's talk about the stop loss. Again, it's just as easy. Your 34 EMA on the close, I call it the warning track. I call this the warning track because things haven't quite gone bad yet, but you'll notice once we touch that, the grab candles go blue. This could be a sign that you may not want to continue utilizing this strategy, or that it's going to be a little bit more heat in terms of the market reorganizing and going bullish again in the case of an uptrend like we have here. So having the grab candles here, the blue is a warning. Hitting the 34 EMA on the close is when the candles go blue. So, actually getting below the 34 EMA on the high is when the candles go blue, but when they start touching this thing, you'll start seeing blue candles are coming maybe even before they touch the 34 EMA close. But once they hit this, it's a warning track, and usually, almost every time, you're going to deal with a blue grab candle at the warning track, 34 period EMA. It's your first warning that there could be a shift in sentiment. It's that organization of bullish sentiment that we've been capitalizing on. Yes, just like in the downturn, it was the organization of bearish sentiment. It's a pretty good reason to possibly shut it down. I hope everybody gets that. The 55 EMA on the close is your absolute stop loss unless, and this is the same exception we use for swing trading and momentum trading and everything else, unless there's a major psychological level or some sort of significant reason that a level just beyond it could be support. But if we don't have that, the 55, in this case, minus 3 to 5 pips, and you're out. Okay? Again, unless there's some significant support level, major psych level, double zero, past support that really is a significant level to respect, and it's just beyond the reach of the 55, in this case just below, then we can make an exception to using this as the hard and fast stop loss. But this is your stop loss, minus 3 to 5 pips. That's the price at which you say, okay, this trade is no longer valid. Very similar. I hope you see all the parallels between swing trading and between the greens. Because once you understand the parallels, I think this becomes very simple. But we're not pulling fibos. Notice that? We're not doing a whole lot of other analysis. We're keeping it very visual. We're keeping it what? Very simple. Today's day trading mantra, right? Really, that's what we seek to do with all our trading styles. Keep it simple. And to me, visual, for me, is simple. If I can just glance at a chart and make some decisions that I'm confident about regarding sentiment, momentum, and trend, I'm golden. All right, so let's wrap up here because we've walked through all phases of this, from when, understanding the timing of the market, when we would consider using it. I like the opens. That's my preference, but really you can utilize it at any time. The opens tend to have the volatility. That's when you'll notice most day traders in futures and stocks are very, very busy. I think it's really no different when it comes to Forex. In fact, this strategy was born of my stock and my futures trading. This is the way I used to do that back then. So it's just been applied to a market where I think it works even better. So between the greens, your two green lines create your zone. If it's an uptrend, it's a buy zone. If it's a downtrend, it's a sell zone. Your 34 period EMA close plus blue grab candles become your warning. Your warning and your warning track of a shift in sentiment. Your 55 becomes your stop loss in an up or down trend. Let me show you a downtrend. We'll go back to that. Let's go to the Euro US dollar. Euro US dollar 5 minute. Here's an example of the downtrend from today. Between the green, just missed. Between the green, definitely. Sentiment started shifting. There's your warning. Boom, you're definitely stopped out here. Some of my traders, by the way, I will say, as soon as we go blue, they shut it down. A lot of them do that. Sometimes that's premature, but a lot of times, as you can see, especially today, it pretty much nailed it. So you have all the tools you need to make decisions about sentiment, momentum, and trend. How you react to them is going to be up to you, your risk appetite or your risk aversion, but the tools are here. You have the general rules and the guidelines. Now you can make some decisions on your own. Say, Raghee, I may not want to wait until prices get up to the 55 EMA close. I see a shift in sentiment. my momentum and my sentiment have shifted, I'm gone. And that's fine too. That's why I've shown you how to set these charts up in this manner, and I'm going to make sure we have a grab only available for this 5 minute, because it really makes a difference. By the way, I didn't always have it set up like this. I didn't always remove the wave and keep the grab. What I used to do is have the wave and the grab on one chart and then just my 13, 21, 34, 55 on another. This streamlined it all, and I really like it much, much better. This really made it much easier. So you have your entry, you have your stop loss. What about management? I will tell you right now, gang, day trading is a little different an animal, because yes, you can go back and look at past highs and lows, but it really is oftentimes simply a momentum game, or a game where you start to notice that a psychological level is holding, or that past support from the day or so ago is starting to kick in. But management really is, I will tell you, I hate to say it, a lot of feel. A lot of feel. So what I'll tell you to do is look at major and minor psych levels. What does that mean? I think the easiest way to start off with this, in my opinion, if you're going to do this, is to go ahead and focus in on your major and minors. Your minors are your 20 and your 80 pips. And you should already know, because I talk about majors all the time, your major is, of course, your 00 and your 50 pip. So then look at the chart and try to find, okay, that's a 3605, so that's right near the 3600. 31, let's see, 3635, 3645, that's right beyond your 50 pip, right up in there. So hunt out your major and minor psychological levels. One thing you can do to make it easier is go ahead and grab your vertical tool line on your IBFX Trader 4 platform and start putting in the major and minor psychological levels. 3600. Boom. I'll grab the horizontal line again. I want to know where 3550 is going to be. So I'll go ahead and put 3550 in there. Okay, if I want to know where the minor psychological level is, go ahead and do 3580. And one thing you can do if you want is make your majors thicker in width than your minors, or make your minors dots. I mean, I don't know, whatever is easier for you. So then here's your major, and then there's your minor. So you know just at a glance what you're dealing with. So mark all the majors and minors that are in play. Mark the 20 pip. So you want to go ahead and maybe mark your 3520, 3620, mark all these levels off on your chart. So as you cross majors and minors, you can begin to pay attention to, it's like, for example, take a look. We bottomed out here, it triggered some more between the green short, we bottomed out again, it triggered some more, and we kept stalling. And if I didn't really think about the fact that I'm right there hovering above 3550, I may not have thought anything of it. From this short here, I could have realized, boom, a 3580 right away. Go down again, we kept hovering just below this. I may not make it to 3550. This is where that feel comes in. Okay, these lows weren't on 3550. So these were 3560, 3555, 3551. They were just hovering above it. But if I didn't already mark this as a major psychological level, it may not have triggered in my mind, wow, you know what? There's a lot of buying support that seems to be waiting just above the 3550 major psych level. So this is why it's so helpful to have the major and minor psych levels laid out. And you saw it took me just a few seconds. That's how you manage this trade. It's got to be that simple, gang. Now, the more comfortable you get with this, you might get comfortable drawing, say, Fibonacci extensions. I like doing that, but I'm also very quick at doing that. You might look at previous highs and lows, but we didn't really have a lot of that to rely on, did we? Sometimes we do. Sometimes you'll notice the previous day's price action offers levels that you can move forward that we might use as support or resistance, but sometimes it doesn't, and that's why I think it's a must that you put the major and minor psych levels up, just as I have here. Notice how helpful it was in really managing the move lower. And I'm just talking about the 00, the 80, the 50, and the 20. That's it. Makes life a whole lot easier when it comes to realizing where the buying support and selling resistance might step in. And that is between the greens, my friends. It's really that simple. How simple is it? Make sure, the first couple segments of our talk here, we're really making sure you understand when you're going to utilize this tool, understanding the rhythm of the trading day. That's always important, regardless of between the greens. Looking at the volatility that accompanies each financial center. Then looking to which short-term time frames, 5-minute, are trending. Utilize a visual tool, in this case Fibonacci-based exponential moving averages, cousins to my 34 EMA wave. Waiting for the corrections, very much swing trading. But instead of using Fibonacci's and other things, I'm using a very visual footprint of the area between the 13 and the 21 period EMA. Stop losses are just as visual. I'm utilizing the 34, I'm utilizing blue grab candles as a warning. The 55 is my hard and fast stop, with the exception being a very, very close proximity to a major psych level. Trade management. Utilize the major and minor psychological levels. Some traders like pivots as well. I'm not a huge pivot fan. I'd rather just pull a Fibbo. I purposefully did not use Fibbos here because I realize that is a class unto itself, an extremely subjective tool and one that not everybody uses, but major psychological levels everybody can do just what I did. And here, just in this example, you see how effective it actually was. I hope this talk was helpful. It's probably the most comprehensive sit-down discussion of Between the Greens I've ever done. This is my day trading in its entirety, the thinking behind it, the timing behind it, and the tools behind it. I hope you'll go out and use it with success. I'm Raghee Horner, and thanks so much for joining me.